Tax season is now in full effect, and while most people wait until the very end to file the return, I wanted to release today's video with a good 2 months worth of notice before tax season wraps up on May 1st this year, so that you had the information well ahead of time before actually completing your own return. Now today's video is following a video I made a couple of days ago on the channel speaking about a free tax filing service called Simple Tax. Definitely check out that video if you're interested after watching today's video, where we'll be covering 5 things to consider for your personal tax return this year that may or may not apply to you depending on your financial situation. This of course is because taxes are highly personal to the individual in question and can get quite complicated, which is pretty much why the entire accounting industry even exists in the first place. But if you have a relatively simple income situation and return, there's really no reason as to why you wouldn't be able to do this on your own. So with that said, let's get into it. And if at any point in today's video you find value, please take a second to drop a like and consider subscribing to this channel for more personal finance and investing content. Let's get into it. Alright, so filing your taxes can definitely feel like a chore that offers little to no value to you, because generally it takes quite a bit of time to put everything together, and you're also giving the government a sizable chunk of the income that you generated over the course of the previous year, which in Canada can be as high as around 55% depending on the province that you work and live in, as well as the type of income you're generating, specifically T4 income, meaning income that you're making from working a job as an employee. Right, so if you hit it out of the park this year and make say $150,000 worth of commissions at work living in Ontario, well, without any other deductions that can reduce your tax bill, you're looking at just shy of $50,000 worth of income tax. Now, why do I bring this up? Well, it's because properly declaring your income tax should be approached with somewhat of a game plan in mind, because it has a huge impact on your global financial situation and personal finances, therefore translating over into what you're able to qualify for on loans, be it a car loan, mortgage loan, personal loan, or what have you. Essentially, what I'm trying to say here is that if you're someone who's serious about your personal finances, then filing your taxes should be more than just a defensive end of year task. Rather, it should be approached as an offensive part of your global financial picture, with even 1, 2, maybe even 3 or multiple years down the line taken into account. So here are 2 different scenarios to exemplify what I'm speaking about. 90% of you watching are probably employed, with most of your declared income being from a job, meaning your tax return is probably nothing more than a T4, potentially some investment income, and that's really about it. But where you may have a little bit of maneuver is with, say, RRSP contributions, which essentially allow you to lower your overall taxable income, therefore paying less tax. Now, RRSP contributions are determined based on your previous year's declared income, and unfortunately, by the time this video comes out, RRSP contributions for the 2022 fiscal year will already be closed. However, the points remain the same and will still apply to, say, next year's return, as well as some other deductions that you may have personally for your own return. The thing that's pretty cool about RRSP contributions is that you can make them, but then choose to only declare a portion of those contributions for your current fiscal year's tax return, to then carry over the balance of your contributions over to the next year or even years in the future. Now, why exactly would you want to do that though? Well, it's because in Canada, income tax works on a marginal tax bracket basis, essentially meaning the more money you earn, the more you pay on a relative basis. So if you're making, say, $110,000, that would put you in the 26% federal marginal tax bracket, meaning you would only require around $10,000 worth of RRSP contributions to lower you into that lower tax bracket, essentially meaning you would be paying quite a bit less on a relative basis in taxes. Right, so in that same example, let's say you made a $15,000 RRSP contribution, well, you could choose to strategically only declare $10,000 worth of that RRSP contribution this year to lower yourself into that lower marginal tax bracket, then carrying over an extra $5,000 for next year for a more global strategy around lowering your taxes overall this year and next year. Additionally, unused RRSP contribution room does get carried forward. So if you know that you're going to, say, get a pay raise next year and make $25,000 more, well, it can be strategic to essentially keep that contribution room for the next year, so that you're therefore able to lower your overall taxable income into lower tax brackets. Essentially, tax deductions end up hitting harder when you're making more money because you're paying more on a relative basis. In a second example here, for people who are self-employed like myself, or you may be choosing to pull out money from your corporation in order to pay for your living expenses, well, declaring a proper amount of either dividends or salary is going to be very important, not only to just determine how much you'll be paying in income tax that year, but also for your ability to qualify for loans, which is extremely important, especially if you plan on investing in real estate. This is because banks will only look at your declared taxable income and will generally look at the past 2 years average of that declared income as a self-employed individual. So if you declared, say, $50,000 in dividend income from your company in 2021 and then say $60,000 for the 2022 fiscal year, this would mean that when applying for a loan, the bank's going to look at those 2 past years and make an average. So $55,000 would be your average there, and then they would use that figure to determine your current debt to income ratio and whether or not you'll qualify for a loan. Now, this could not be more important as part of an offensive strategy if you're in this same boat. And I'm speaking from experience here. Over the past 2 years, it's been extremely difficult to qualify for any loans whatsoever. The reason being, 3 years ago, well, I was still working a job that was basically bulletproof in terms of qualifying for loans. I was still making $50,000 to $60,000 from that job that was at the government of Canada, which banks absolutely loved. So for that reason, I only declared something like $10,000 or $15,000 worth of dividends from my company. Well, fast forward to quitting my job and then last year only declaring $70,000 worth of dividend income without really thinking things through. That meant that my average of dividend income over the past 2 years was like $40,000, which with a house as well as a car really didn't leave any room for maneuver for any purchasing and acquiring of rental properties. And that right there is a massive problem as a real estate investor, not being able to access debt capital. So what's the solution to this? Well, this year I over declared my dividends, even though I didn't actually need those dividends to live off of, but I pulled that money out of my company so that my average 2-year dividend income from my company was quite a bit higher, and I was therefore able to qualify for loans. This is the type of thing that you need to strategize on your tax return if you're someone who's really serious about your personal finances and your investing, who may be in this type of situation. So the point to all of this is that you really need to treat your tax return as part of your global personal finance strategy and as something that's offensive rather than playing defense 2 days before May 1st. All right, moving on here. Most of you are probably already aware of this, but for anyone who's new to filing your taxes this year, depending on how your investments performed over the course of 2022 and what your actions were within your investment account, you could potentially be eligible for what's known as tax loss harvesting. Chances are you know what capital gains are, which is what every investor seeks to achieve, then only paying taxes on half of the capital gain in question. But the opposite also applies depending on the situation, where if you have a capital loss on your investments, you're also able to declare that on your tax return, thus lowering your overall taxable income. Essentially, if you sold off any of your investments at a loss over the course of 2022, well, you're able to deduct that loss from any capital gains that you'll also be declaring and that you materialized in 2022. So let's just say, for the sake of example, you bought $1,000 worth of stock in 2021 at the top of the market and chose to sell that off at a 30% loss, so $300 over the course of 2022. Well, if some of your other investments went really well and you made a $500 capital gain, you're able to deduct that $300 from the $500 worth of capital gain, therefore only paying capital gains tax on the $200 that's left over. Additionally, like with the RRSP contributions, you're able to carry forward indefinitely any capital losses that you have declared. And so for this reason, you're able to also use this as part of a global strategy if you know you'll be making more capital gains over the course of next year or a year in the future. A couple of things to consider though: this doesn't apply to investments within a TFSA. So if you unfortunately sold at a loss within your TFSA, you're not able to declare any of those tax losses to offset capital gains on your tax return. This only applies for cash as well as marginal investment accounts. I thought I'd mention this though because the past year or so have been quite difficult for the market, and chances are a few of you have sold some of your positions at a capital loss that could very well offset any other capital gains that you've incurred previously over the past 3 years. Oh yeah, that's one other thing to mention here. You're able to offset any capital gains in the past 3 calendar years as well with any new capital losses. So that's something that you should definitely be thinking about and strategizing. Moving into the third element to consider this tax season, unfortunately, it will not apply to me because I'm a Quebec resident, but a lot of my viewers are based in Ontario, and this will then apply to you. I'm talking about the Ontario tax credit for travel. Basically, any Ontario resident will be able to claim 20% of their eligible accommodation expenses, including hotels, Airbnbs, cottages, and so forth that were incurred over the course of 2022 and that were in Ontario specifically when filing their personal tax return this year. Now, of course, there is a cap to this. You can claim up to $1,000 worth of eligible expenses as an individual or $2,000 if you're filing as a couple here, allowing you to get back around $200 as an individual or $400 on a global tax return with your spouse. So still though, a nice little bonus here if you're an Ontario resident who did travel this year within Ontario. I definitely would have actually qualified here. Oh well. Next up, we need to speak about personal business income, because over the past 4 years with the internet and people like myself encouraging my audience to go out and create more income streams through a side hustle, an extra job, or even a small little side business, well, of course, all of this needs to be declared income on your personal tax return if you didn't go through with creating a corporation and then funneling all your income through a corporation. We're speaking here about a smaller little side business that you're personally going to be declaring that income for. Now, this also opens the door though for business deductions that you need to be aware of. You see, unlike with income from your job, where there may very well be other deductions on your pay stub like insurance premiums, pension contributions, and so forth, well, generally speaking, T4 income from your job isn't going to be eligible for any other type of deduction that's in relation with the cost of doing business. And this really is where business income differs from T4 employment income, because with business income, you're able to deduct from your total gross income any expenses that you incurred that allowed you to generate that income in the first place. Now, you may very well already be familiar with this, but I'm repeating it here because I know a lot of people started small businesses over the course of the pandemic and may be completely new to declaring this business income on their personal tax return. For most of you though, who may have started a small business from the comfort of your own home, you might actually be able to deduct a portion of your Wi-Fi, your cell phone bill, as well as other things such as even a portion of your rent or mortgage payment based on the amount of your house that you're actually utilizing for your business. All of these things need to be taken into consideration and can have a huge impact on your bottom line and how much you'll be paying in tax. So do yourself a favor if you're in this position yourself, do a bit of research here and determine all of the different expenses that you'll be eligible for based on your small business. So if this is the case for you and you will be declaring business income for the first time in your personal tax return this year, you'll need to fill out what's known as a T2125 form, which is basically declaring personal-based business income. And it's pretty straightforward actually to fill out, especially if you utilize something like Simple Tax. Again, definitely check out the video I recently made on the channel covering how you can file your taxes for free with that platform. It's really just a matter of inputting how much you made on a top line, and then it'll guide you through all of the different expenses that you can declare. Another thing to consider here is that let's say it's your first or even second year of business, it's completely normal that you might be in a position where you're not actually making any profits and you're even in a position of losses. Well, what's cool here about business income, even at the personal level, is that you can actually deduct those business losses from your total taxable income, including even offsetting some of your T4 income from your job. That's again something to take into account. And finally, even though property transactions are massively down year over year, so many people purchased a home or other type of property over the course of 2022. In fact, there were over 500,000 property transactions in 2022, meaning a heck of a lot of new first-time home buyers that will be able to take advantage of the first-time homebuyer tax credit this year. If you weren't aware of this, in Canada, when purchasing your first home, you're eligible for a non-refundable tax credit when purchasing your first home, essentially meaning free money on your tax return this year, which previously was up to $750. Well, for 2022 and moving forward, this non-refundable tax credit has now increased to $1,500, which is somewhat of a nice consolation prize if you battled for your life and a bidding war in 2022. So there you have it. Those were 5 things to consider when you're strategizing and filing your tax return this year and really any year moving forward. Always make sure you're strategizing your tax return and looking at this from an offensive standpoint, because this can truly make a huge impact on the amount of tax that you're paying over the years, as well as your ability to acquire assets. As always, really hope you enjoyed the video. If you did, make sure to drop a like and subscribe to the channel to be updated on new and upcoming investing and personal finance content. Don't forget also to check out my previously released video about filing your tax return for free this year that you can check out right here. On that note, thanks all for watching, and I'll see you in the next one.